As a reminder, or if you're watching this video first, we're going to play through the Kahoot game. But having said that, what we will do is I will read the answer and then I will wait like 2 seconds and I will go to the possible answer choices. You'll be watching it on YouTube, so you can pause if you would like to take time to think about the answer. It just helps us for recording purposes to be able to move through efficiently. So get ready, get set, and we will get started with this one on finance, real estate finance. One. Question number one. Which of the following is true regarding title theory? A, the borrower retains equitable title. B, the borrower retains legal title. C, North Carolina is not a title theory state. Or D, the lender may not foreclose. After taking a couple of seconds on that one, hopefully you will remember that the borrower retains equitable title. Now, here's the idea of equitable title. Remember that in the title theory states, there are three parties. The borrower is the trustor. What they do is they give up title to the property. Now, it's a conditional conveyance, but they transfer the title to the trustee to hold as long as there's a loan on the property. The trustee holds it for the benefit of the bank, who is known as the beneficiary. Equitable title always means as long as you do what you're supposed to, you're eventually going to merge legal title as well. So you can see that legal title is not correct because we've already dealt with that. North Carolina is, in fact, a title theory state. So to say it's not would be untrue. And of course, the lender may foreclose. Otherwise, they would not give you money and have a lien on the property.
All of the following are true regarding a deed of trust, except a deed of trust is a three-party instrument. Borrower conveys bare legal title as security for the loan. A deed of trust is a two-party instrument. A trustee holds title on behalf of the lender.
Right, good answers there. And of course, the correct answer is, remember, we were looking for the except here. So this, a deed of trust as a two-party instrument is incorrect. That would be more of the lien theory states. They are a two-party instrument. Deed of trust is a three-party instrument. And then also one of the answers that you may not have seen, I don't know that I use this word a whole lot, but the borrower conveys bare legal title, sometimes referred to as naked title. I don't want to get too, what's the word here?
In the weeds,
Yeah, I don't want to go too far in the weeds on this one, but the idea is that when they convey the bare legal title, there's nothing the trustee can do with it, and that's why it's referred to as that. Question number three, a promissory note. A must be recorded. B is a written promise to pay. C is the document that pledges property as security for a loan. D is not legal in North Carolina. Good question. The answer on this is that a promissory note is a written promise to pay. It's another name for an IOU. Now, why would I say that this was a good question? Look what the first potential answer was, must be recorded. What they're trying to trick you into thinking is to make a mistake between the promissory note and the mortgage note. The promissory note is just a promise to repay the debt. As a matter of fact, you probably signed one if you ever purchased a car, but obviously that's not recorded. The mortgage note is the thing that has to be recorded because that's the collateralization instrument that allows the bank to take your property if you don't pay the debt. Was there any question about any of the others? I think they're pretty straightforward. Okay. Your turn.
All of the following are true regarding a mortgage or deed of trust, except must identify the lender and the borrower, must include an accurate legal description of the property, must be recorded and delivered accepted by the lender trustee, must be signed by the lender.
This one's a little bit tricky. You're like, good gosh, it seems like the lender would want to sign it. But remember, throughout this class, basically what we were looking for here are the essential elements of a valid deed, which would also apply to a deed of trust because a deed of trust is a type of deed. And remember who it is who signs the deed or deed of trust. It's the trustor, not the beneficiary, in this case, the lender. And so, no, the lender doesn't, in fact, have to sign the note. Now, they have a lien against your property, whether they sign it or not, because it's going to be a recorded interest. But that was kind of a tricky question. Question number 5. The acceleration clause allows the lender to A, declare the entire debt due immediately. B, allows the lender to charge a fee to pay off the loan early. C, require payment of the loan in full if the property is sold. Or D, sell the property if the borrower does not pay. This question actually turned out to be trickier than what I meant for it to be. We need to add some words to A on that, but it's still technically correct, so I'm going to stay with it. The acceleration clause allows the lender to call the note immediately due. Now, here's the way I remember that. You choose whatever you want to, but I think of the word accelerate, to hit the gas, because what happens is typically the acceleration clause is associated with a breach or a default. In other words, you stop making the payments to the lender, and then the lender will call the note due. So basically, number one is correct that they can call the entire note due immediately. You say, well, why were the others wrong then? You see, one of them says allows the lender to charge a fee to pay off a loan early, has nothing to do with this situation. That's a prepayment penalty clause. The other one that was close is require payment of the loan in full if the property is sold. Now, while that does have a similar type effect where they're calling the note due, it's for a different reason, which I'll hold off for because I feel almost certain that a question's coming up about it shortly. Speaking of which, your clauses to the deed of trust, you need to be really familiar with them.
Non-judicial foreclosure is made possible by which clause in the deed of trust? Acceleration clause, due on sale clause, prepayment penalty clause, power of sale clause.
And the answer to this one is the power of sale clause. Now, I don't need you to get super deep on these, but I need you to make associations on this. In title theory states, we do non-judicial foreclosures. Non-judicial foreclosures are done under the power of sale clause. If you make those associations, you're probably fine. To be quite honest, if you want to know a little bit more, I'll tell you more. Indeed, lien theory states they actually have to go through the equivalent of a civil action in front of a judge before they can foreclose on a property. But that's not how we do it in North Carolina. There's a clause in the deed of trust that says, after doing the appropriate postings, after doing the administrative hearing in front of the clerk of court, then we're going to foreclose on this property.
All of the following are true regarding a balloon payment loan, except regular payments won't pay off loan by end of the loan term. Final payment is an amount that is larger than previous ones. Lender is required to extend the loan period when it expires. A term loan always has a balloon payment feature.
So we're looking for the exception
Except.
here, right?
Mhm.
Okay. And of course, the answer here, the exception is the lender is required to extend the loan period when it expires. That is not true. If you got a 5-year balloon payment loan, if, for example, if you had a 5-year term loan with a balloon payment, then on that 60th payment, you got to either pay it off or the bank could issue go into a foreclosure action for you on that. Here's the thing with a balloon payment loan, though. The fact is that most people know, again, if you had a 5-year term loan, if you had a 5-year interest only loan with a balloon payment, meaning the last payment's going to be bigger than the rest of them, most people know that during that 5-year period, they're either going to sell the property or they're going to refinance the property. That's why people take balloon loans. Were there any of the others that were confusing?
I don't think so. They all seem like they make sense.
Okay, good. All of the following components are known at the inception of the loan in an adjustable rate mortgage, except. I'm sorry to keep asking all these except questions, but if they're good for practice. Will the cap be known? Will the index be known? Will the interest over the life of the loan be known? Will the margin be known? Cap, index, interest over the life of the loan, or margin? Which one will not be known at the inception of an adjustable rate mortgage? Now, this is another one that you could back into. I remember teaching this class recently, and every time I go over these terms, people are like, I don't know what you're talking about," because they're terms that you're not super familiar with. In association with an adjustable rate mortgage, the cap is how much it can go up. The index is based on the bank's I'm sorry, the index is based on how much it's going to go up in any given time. For example, it may be based on LIBOR or the consumer price index or T-bills or something like that. The margin is the bank's profit margin on that. So it's possible that you look at those and you're like, I don't really know what those terms mean. But then look at the answer that was the exception, interest over the life of the loan. Think about it. With an adjustable rate mortgage, you don't know how much it's going to go up year to year. You don't know exactly what your payment's going to be. So it would be impossible to predict what the interest would be over the life of the loan.
I think that's probably a good one. You need to really know your vocabulary on that one to make sure you can understand what those things are.
Yeah, I think in the finance chapter, more than any other chapter, vocabulary is a huge deal. And I like to say being able to make an association, one or two drill downs from that association. Question number 9.
Pledging property for a loan without giving it possession is best described as hypothecation, defeasance, alienation, novation.
Good vocabulary words there. And their answer, of course, is hypothecation. One of my favorite words in real estate. I just love the way it sounds coming off the tongue, hypothecation. So literally just a vocabulary word. The idea of hypothecation, if you think about it, it's what we all do. If you owe money to the bank on your house, you owe the bank money. They have a lien on your property, but you still get to live there. You still get to paint it whatever color. You treat it like your home. Number 10. All of the following are true regarding a discount point, except. And the answer is required for every loan. Discount points are completely an option. And actually, at times, they're kind of out of vogue. For example, when interest rates were down between 3 and 4%, people weren't paying discount points to lower their rate. And so they're certainly not required. When you look at the answers, I do want you to know the answers that were wrong, meaning that they were in fact true. A discount point in this class is going to be 1% of the original loan amount. Now, how are we going to try to trick you on the exam? We're going to try to make you think it's 1% of the sale price, or if it's some flat fee out there, like $1,000 or something. That is not true. It's always 1% of the loan amount. It is, in fact, prepaid interest. And one discount point will change your interest rate 1/8%. Now, think about this. Some of you got bogged down with the idea of a yield versus a buy down. Remember, if the lender is collecting money up front, interest up front, it increases their yield on the property. If I'm a buyer and I'm paying a discount point, the reason I'm doing it is to buy down my interest rate. It's the same thing. It's just a matter of perspective.
All the following are lenders in the primary market except credit unions, mortgage brokers, pension funds, Fannie Mae.
And your answer there, of course, is Fannie Mae. And look, I don't know if they'll do this to you on the exam, but this is one case where I would know my acronyms. Fannie Mae is FNMA, which looks a lot like FHA when they're beside each other on the exam. Well, Fannie Mae is a secondary market institution, so it's not related to any of these places where you would go to get finance. And so vocabulary, read it closely and just make sure you don't make a silly mistake on that one.
And what are secondary markets, as a reminder?
Secondary market institutions buy mortgage-backed securities, which are created in the primary market. So I often say that a secondary market are investors acting in their best interest buying mortgage-backed securities that are created in the primary market, which provides for liquidity in the primary market. If you want to go a step further, they also avoid disintermediation. Disintermediation is described as the drying up of funds in the primary market. Well, how do you prevent it? You just keep funds coming from the secondary market into the primary market. It's more than you wanted to know, wasn't
Yes.
it? Your turn.
The secondary mortgage market does all of the following except purchase existing mortgages, services mortgages, originate mortgage loans, replenishes funds to the primary mortgage market.
All right. Oh, so when you look at that, all of those other three things are in fact true. The one that is not true is they do not originate mortgage loans. This is kind of like the other side of the previous question here. So we're really trying to pound this home to you. Don't get tricked into thinking that the secondary market provides loans in the primary market. They do not. They do not originate mortgage loans. Number 13. Which of the following is true regarding a VA guaranteed loan? There is a prepayment penalty for all VA loans. VA loans are not assumable. A VA guaranteed loan protects the lender in case of default. A veteran may only obtain one VA loan in their lifetime. We're looking for the true statement. And the true statement is, of course, that a VA guaranteed loan protects the lender in case of default. Now, this is not perfectly true, but it works kind of like this. The VA program protects the lender on the top portion of the loan. So let's say, for example, that a veteran's entitlement is a certain figure, maybe $69,000. I don't quote me on that. I'm not sure what it is now, but a bank would normally loan 4 times the entitlement. And you say, well, what's the significance of 4 times? Well, think about that. If the VA were to guarantee the top 25% of that loan, keep in mind if the veteran can't pay and they put it on the market to sell as a foreclosure, surely the lender can get back 75 cents on a dollar on that. So that's not a perfect explanation on the way it works, but that's how the VA protects the lender in the event of a default or foreclosure. There's one on here that was kind of interesting. Oh, a veteran may only obtain one VA loan in their lifetime. The trick to that one is that they typically can't have more than one at a time, but they can have one, pay it off, and then, of course, get another one on their next property. That was the trick on that one.
Which type of loan requires a certificate of reasonable value, or CRV? Conventional, VA, FHA, reverse annuity. I said I always think of a Honda when I see this.
Yeah, that and realistically, if you just relate this to VA loans, you're going to be fine. As usual, I'll say more than I should on this, but a CRV is basically a VA appraisal. If I wanted to add another bullet point to that, it would be this, that VA appraisers have to be approved. In other words, not all appraisers can do VA loans. It has to be VA approved to do that. And a certificate of reasonable value this is not completely true, but it's close to true. Not only is it an appraisal, but the appraisers are also going to be looking for things like deferred maintenance. In some ways, it's a little bit like an inspection, not really, but sort of like that. In other words, they're trying to protect the veteran by making sure that the house is going to be not only worthy of its value, but also a solid building as well.
Which of the following loan types involves no participation by the federal government? Conventional, FHA, rural development, VA.
And your answer is conventional, requires no participation by the federal government. And always remember, FHA is a government insurance program. VA is a government guarantee program. Rural development program, man, that is a hard word for me to say. Rural development programs are actually government funded programs to encourage growth in rural communities. Sorry, our dog's trying to participate. We'll take him outside so that he won't disturb us. Which of the following is true regarding FHA loans? A, the rates are set by HUD. B, they insure the lender against loss in the event of default. C, HUD provides the funds for the loan. D, they require larger down payments than conventional loans. And the answer, of course, is they insure. Notice I said that FHA was an insurance program. Notice how we tried to trick you in the other questions. HUD doesn't set the rates. They don't determine, what the terms are going to be for these loans. All they do is insure the program. The FHA program is an insurance program. Every borrower that's in the FHA program pays what's known as an MIP, a mortgage insurance premium. And all of this money goes into a pool, and that pool is designed to protect lenders in the event that an FHA borrower is found in default.
Which of the following clauses requires the loan to be paid in full in the event of sale? Defeasance, acceleration, power of sale, alienation.
All plausible answers there. That's a really well-written question. And the answer is,
Again, you're saying that because you wrote it, right?
of course. The answer is the alienation clause, also referred to as the due on sale clause. I think it's safe for us to say that alienation and due on sale are the same thing. If you want to know what the difference is, in a due on sale clause, that means you sold the property. But the bank also says this, hey, look, if you give the property away, it's your property, you can do whatever, but you owe us our money. So alienation, whether you sold it or whether you gave it away, due on sale. I had those vice versa, but you know what I'm saying on those. All those other clauses are found in the deed of trust, but they have their own separate meanings. So they're again own separate meanings. So of course you see the vocabulary that we talked about. 18 of 19, question 18 of 19, a property at foreclosure sale did not bring enough to cover all liens. Which is true? A, unpaid lien holders can continue to have a lien on the property. B, the foreclosure will result in a short sale. C, unpaid lien holders can pursue a deficiency judgment. Or D, the buyer will receive a quitclaim deed due to the shortfall. And the answer is unpaid lien holders can pursue a deficiency judgment. Now, keep in mind, most foreclosure sales, think about this. You probably would not have allowed the foreclosure to occur if you were going to make more money selling it than you would by another means. So by the time it goes to foreclosure, most people are upside down. This is why it pays to be a higher lien rather than a lower lien. Remember, at a foreclosure sale, remember who gets paid first. There's a trick question we could ask you about who gets paid first, because the first one to get paid at a foreclosure sale are going to be the attorneys, what we call the cost of sale. The next one to get paid is going to be real property taxes. And then, of course, you get paid off liens based on what their lien priority are. So it pays to be a higher lien. Down at the bottom of those liens, you get to second and third, what we call junior liens. If there's not enough money left, you don't have a right to have a lien on the property any longer. That was the purpose of a foreclosure sale. Let me mention to you another popular question. Another popular question goes something like this. A foreclosure sale pays off all liens. Well, that's not true. A foreclosure sale clears the liens from the title. That doesn't mean it paid them off. So watch that one really, really careful. Be disciplined on that question. And hopefully you know what all of those things mean. If not, shoot us a message and we'll give you some more information on that. And then the final question is, which of the following would not be a trigger term under Regulation Z? Low down payment of $3,000, low monthly payment of $667 per month, HOA dues only $50 per month, 240 simple installment payments. And your answer is HOA dues only $50 per month. Now, here's why. All the other are specific finance terms. For it to be a trigger term, it has to be both specific and a finance term. Well, you look at the HOA dues, and you're like, well, man, that's significant. That's a specific term. Yeah, HOA dues, it is a specific term, but it's not a finance term. So therefore, it did not qualify. It would not trigger full disclosure of all other loan terms. So with that in mind, you have wiped out the first section of finance, a lot of vocabulary, a lot of associations, get really sharp. I'd take a lot of questions on them. That's the way I would do it. So use your learn test pass pretty tight on this. We wrote the questions to learn test pass to be very difficult when it comes to the finance chapter. And I believe it's actually based on recent scores. I believe it's actually testing very easy right now. So if you're well trained on this vocabulary, you should do extraordinarily well on the finance section, which there are a lot of questions. All right. Well, we're through with this section. Good luck. Let us know if you have any questions.